Mark Zuckerberg's bold AI bet had many investors worried, but it's already paying off with 2024 results crushing expectations and the stock soaring above $700. So, what are Zuck's plans, and should you buy Meta now or wait? Let's dive in and find out. In this video, I will cover Mark Zuckerberg's bold AI bet and plans for the future, what I think about Meta stock and its value, what Wall Street's smart money says, and what you should do based on this information. Mark Zuckerberg made 4 significant revelations in the 2024 earnings call, and it will completely reshape the future of AI and social media. Meta is building a new 2 gigawatt AI data center so large it could cover a significant part of Manhattan. In 2025, CapEx will increase nearly 70% to upwards of $65 billion, literally more than they made in net income in 2024.
That's ambitious, man.
Also, Meta is making their own custom AI chips to reduce their reliance on NVIDIA. Zuckerberg stated that 2025 will be the year where a personalized AI assistant reaches over 1 billion users, and Meta is positioning itself as the leader. Llama 4, Meta's open source AI model, aims to outperform closed models like OpenAI's ChatGPT and Google Gemini. Meta's Andromeda AI system has a 10,000 times more powerful AI for personalized ad targeting, leading to higher conversion rates. AI-driven Advantage Plus shopping campaigns hit over $20 billion in annualized revenue, growing 70% year over year. Reels and Threads are poised to capture TikTok's audience if regulatory action weakens ByteDance in the US. Threads has 320 million monthly active users, adding over 1 million per day. Despite nearly $18 billion in Reality Labs losses, Meta remains committed with AI wearables and mixed reality headsets as potential growth areas. Meta's Ray-Ban AI glasses are a breakout hit, selling strong. Meta believes this could be the next big computing platform, possibly competing with Apple's Vision Pro, and the target is 5 to 10 million units by the Gen 3 launch.
Nice glasses.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's 3 financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
Nope, feel fine.
That is what you are doing when you buy a stock without understanding the 3 financial statements. If you want to see what I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Meta has almost $44 billion of cash, and if we combine the cash invested in securities, it's almost $78 billion. This gives the company a ton of money to invest in the future, whether it is AI or the Metaverse. We'll see this later in the cash flow statement. PP&E increased over 25% since 2023, and it's projected to nearly triple in 5 years by the end of our model. With a huge commitment to the build-out of a massive AI data center mentioned earlier, this will continue to grow. Some of this funding will come from the almost $29 billion of debt that Meta has, but it is still net cash by almost $49 billion. While the company paid its first ever dividend in 2024, retained earnings increased by almost 25% to over $102 billion. The fact that the company can pay over $5 billion in dividends while still growing its retained earnings is impressive. So what's the takeaway? Meta has tons of cash, its debt is manageable, and it's returning billions of dollars to shareholders. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Last year, Meta generated $164.5 billion in revenue, with 97% coming from advertising. Revenue growth was almost 22%, the highest level in 3 years. Margins expanded across the board, which is a tremendous positive, showing operating efficiency. After a rough 2022, Meta reached margin levels in 2024 that it has not experienced in 6 years due to layoffs and aggressive cost cutting. Meta achieved net income of $62.4 billion in 2024, more than the last 2 years combined. Because the company has aggressively cut costs, more money flows to the bottom line, which is great for investors. So what's the takeaway? Top line revenue growth over 20% combined with cost reductions means expanding margins and increasing profits for investors. The cash flow statement tells us where the cash is generated by the company, and there's 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash, making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. The operating cash flow is primarily driven by the strong net income that Meta is generating. While we see the increase in CapEx to fund Metaverse investments and AI initiatives, there's something amazing going on here. Marketable securities generated $15.8 billion, a more than 2.5x increase from 2023. Meta is generating billions from the nearly $34 billion of cash that it has invested in marketable securities. Financing cash flow is negative, but is not primarily due to paying down debt. What is fascinating is that the bulk of the outflow is due to the massive amount of cash being returned to shareholders. $35 billion, or 86% of the financing cash flow, was due to dividends and share repurchases, putting more money into shareholders' pockets. So what's the takeaway? With almost $78 billion in cash and cash equivalents, Meta is using those assets to generate income, which it's returning to shareholders and reinvesting in the business for the long term. So what does this all mean for the valuation of Meta's stock? Let's cover that next.
I'm following the game quite well.
On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we can take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and in the description. As you can see on the left, we take specific line items we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out into infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out debt, we add cash, we strip out non-controlling interest, we add associate investments. That gives us an intrinsic equity value of $1.7 trillion. We divide by the current shares outstanding. That gives us an implied share price of about $674. Compared to the current share price, it's a 4.3% premium, which is a sell rating. Now, this does not mean that you should sell the stock if you own it, but it's not a good entry point if you don't own Meta today. I'll get into this later on. So what does Wall Street have to say about Meta stock?
Here comes the good part.
Overall, the consensus among analysts remains optimistic about Meta's prospects, particularly regarding its AI initiatives and potential for advertising revenue growth. However, some caution is noted concerning increased spending and regulatory considerations. Bank of America Securities increased its price target from $660 to $710 with a buy rating. Bank of America highlighted Meta's strong cost management and optimism regarding its AI capabilities. They anticipate that AI advancements will significantly enhance advertising revenue and contribute to long-term growth. Citigroup raised its target from $753 to $780 with a buy rating. Citigroup points to Meta's significant investments in AI and the potential benefits from developments like DeepSeek's AI model, which could lead to faster product development and reduce capital expenditures. BMO Capital raised its price target from $530 to $610 with a hold rating. They acknowledge Meta's advancements in AI and advertising, but express caution due to increased capital expenditures and potential regulatory challenges. I'll discuss this in depth later on. This is Capital IQ. I use it a ton. 58 analysts cover Meta on Wall Street, which is a lot. The target price is from a low of 505, which is a 28% decline, to a high of 900, which is a 28% increase. So the downside equals the upside. The median is 770, which is a 9% increase. The overall rating on a scale of 1 to 5 is 1.51, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
I currently do not have a position in Meta, and despite a sell rating in our model, I am a fan of Meta, just not at current levels, and here's why. Meta is going all in on generative AI with huge investments powering everything from content recommendations to ad targeting and hardware innovation. Can they outcompete OpenAI, Google, and others? They're already showing us that they can hold their own. The European Commission and US regulators are scrutinizing Meta's data privacy practices, potentially impacting targeted ads and future revenue growth. Meta needs to work hard to combat this so their progress doesn't doesn't get derailed. Reality Labs, which encompasses the company's investment in the Metaverse, lost almost $18 billion last year and $47.5 billion over the last 3 years. Mark Zuckerberg has warned investors that these losses will continue to grow in the future until the Metaverse gains traction, which is years off. Can the company's family of apps outgrow and outperform these losses?
Time will tell.
Meta hit an all-time high of $718 within the last few days, and despite eye-popping 2024 results, the stock is a little ahead of itself. The stock is up $115 or 19.5% in the last 3 weeks. On Wall Street, we buy with a margin of safety of at least 20%. Based on my model, that means the 560 to 565 range. Since the end of Q3 on September 30th, Meta has traded below 600 60 days or 68% of the time. So if you want to buy Meta, I suggest entering a limit buy order at a price that you're comfortable with. Meta is the only diversified pure-play social media company out there, and their integration of AI into advertising is already bearing fruit. While the Metaverse is a few years off, Meta is leveraging the success in the rest of its business to fund the future. And the potential of virtual and augmented reality are very exciting. If you like this and want to see another in-depth stock valuation, check out my SoFi video here or my Apple video here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.